All right. Good evening, everyone. Thank you all so much for joining us. My name is Teresa Stevens, and I'm the Director of Neighborhood Development and Outreach with Baltimore City Department of Housing and Community Development. This evening, we are really excited, and we've had a really good response to this topic. We have the team from the Baltimore Community Lending Group to present a workshop on financing your real estate project, which is a really important component as many of you all consider working in development projects within Baltimore City. This evening, the presentation will be recorded. This recorded presentation will be uploaded probably on tomorrow at the very latest Friday morning via our DHCD YouTube channel, so you can rewatch it if necessary. And also, we are going to ask that if you have questions, you please post those in the chat until we complete the presentation, and hopefully we will have an opportunity to do a question and answer period. At this time, I'm going to introduce the lead for the presentation, Sean Russell, who is the Vice President and Chief Lending Officer for Baltimore Community Lending, which is a U.S. Treasury certified nonprofit community development financial institution that has worked with Baltimore City Department of Housing and Community Development in the city for a very long time to help support real estate developers and small business owners as they have needs for financing various projects. So at this time, Sean, I'm going to turn this over to you. Thank you so much.
Thank you very much, Teresa, and I hope everyone can hear me pretty clearly. I also want to welcome and thank all of the participants in this workshop this evening, and we as Baltimore Community Lending, on behalf of the entire team, I want to thank you for your participation, and hopefully we will leave you with some very useful information and going forward be able to help you with your opportunities. Just as a housekeeping matter, if anybody isn't on mute, I would suggest that you go on mute unless you're speaking to on the workshop. I also want to thank Teresa and the entire DHCD Vacancy to Value team for giving us this opportunity to, and also thank them for their continued partnership with us. You know, we appreciate this, and this is our time to kind of introduce to you not just BCL, but what it takes to finance your real estate development. So let's get started. Today, we'd like to tell you a couple of things. Our agenda for tonight is to basically let you know who and what BCL basically is, what we do, and how we do it. We also want to discuss general funding sources for real estate projects. That will not just be BCL, but it'll cover kind of a number of sources that are out there for your consideration as you do things. And lastly, we want to outline and discuss our loan products, as well as the loan and underwriting process that lenders go through when they're looking at financing real estate developments for developers like yourselves. So thank you. BCL has got over 30 years of experience in Baltimore City, basically lending to small and medium-sized developers for projects that are basically in underserved communities. There are projects that in many cases aren't able to get financing from traditional banking sources or other lending sources. As a CDFI, as Teresa said, we're certified by the Treasury. We are a nonprofit loan fund with a mission of basically helping stabilize and improve neighborhoods within the city of Baltimore. We're a loan fund. We don't take deposits. And so we raise money and borrow money from banks, foundations, municipalities, if there's ability to do that, and other sources. And we created our loan fund basically to relend on the projects that are the very focus of what you were doing. BCL also has a small business lending division that basically focuses on providing small, emerging, and startup loans to non-real estate businesses within the city of Baltimore. So I mentioned that we've got another division that does that. So this evening, we will be introducing you to the rest of the BCL real estate team, which includes, and you'll hear from Tracy Evans, who's one of our loan officers. You'll also hear from Deirdre Presley, who is an AVP and a loan officer in our division. and Roy Miller, our loan administrative coordinator. And also on the line with us, I believe this evening, is Ned Fields, who is our construction specialist. He's not a direct part of the presentation, but he is very much part of the team and a very great resource for our borrowers and prospects that we do business with. BCL, as a nonprofit and a loan fund, basically, we're mission-based. And we are a lending resource for both small real estate development projects and medium development projects, but also for small businesses, as I just alluded to. This is our mission, just to kind of let you know what we focus on. So BCL's real estate team is focused beyond just on doing loans and working with developers to make projects happen, but we're also very focused on, as a community development financial institution, and mission focused on revitalizing and stabilizing underserved neighborhoods within the city of Baltimore. We also provide TA and capacity building resources, not only for our borrower developers, but also for the contractors and others that they are working with in order to make their projects happen. BCL's loans make development and neighborhood stabilization possible. Our basic loan products include basically a short-term construction-only loan that are typically for projects for builders that are doing rehabilitative or new construction home ownership, for basically to sell to homeowners once their projects are completed. We also have what's called a construction mini-perm, which are loans that basically go to developers who are more focused on doing investment portfolio building projects. And those could include, just doing a number of single-family homes that they want to have rented out and collecting rent and have them in their portfolio, to doing multifamily projects, to doing commercial and residential mixed-use projects, and also doing just straight commercial projects. So we kind of cover the waterfront as it relates to the types of real estate projects. But those loans are typically a construction loan term that basically is coupled with what we call a mini-perm, where it would amortize over a period of longer years, but have a shorter balloon that would probably be a loan that would not last all in more than, say, 5 to 7 years. And for our most experienced developers that we have a built-in track record with, we will consider, when they're doing for their projects, providing a guidance line of credit, which is a revolving facility, which allows developers to do a number of projects, be they scattered or all together, where basically they're typically taking them and using them for home ownership, and basically they're borrowing, drawing down, repaying, and reusing the funds. And that's our guidance line of credit. Now that you've heard about BCL, and we really do have covered all these things, we are focused on financing. We do provide technical assistance and development assistance, as well as just general consulting. And we can go into that in the question and answer if there's more questions that you may have about those services. But for now, we need to introduce you to Tracy Evans, and also have her outline for you just the general financing sources that are available for financing projects in general. So Tracy, why don't you kick it off?
Thanks, Sean, and good evening, everyone. And thank you for participating in tonight's workshop. So we're going to talk a bit about the project funding sources. It takes money, to be very candid, to do real estate development. And what we're going to cover in the next few slides are some of the sources of funds that you may have independently through your savings or through some personal assets that you own, or that you may borrow. And essentially, there are 6 different sources, and we're going to start with those that are most accessible to you, which might be personal savings or home equity loans based on the real estate that you may own. And really, these are the features and benefits. And so for personal savings, think of it as low cost, no cost way to finance your real estate development project, because basically you're using your resources. There are no loan to value requirements, and you have maximum flexibility. So there's not going to be a lender stating terms and conditions for which you might have to follow to use your personal savings. These would essentially be resources that you could use for acquisition and construction of your project. But why we talk about the next funding sources is because typically the cost of a project is going to exceed what you may want to use. You may not want to use all of your personal savings or use home equity from real estate assets that you own. And so there are these other funding sources that are also available to you as borrowed funds. And so we are a CDFI, Baltimore Community Lending is. And here's some of the features and benefits of borrowing from a CDFI such as BCL. We are mission oriented. And our focus is to revitalize and stabilize low and moderate income neighborhoods and communities so that we're going to understand the type of projects that you might be focusing on in Baltimore City. You do have to qualify for the loan. So we do underwrite these loans. There is interest and a cost to our funds, and there are fees. Though typically our funds are less expensive than the type of funding you might get from, say, a hard money lender, which we're going to talk about on the next slide. There are also traditional bank loans. And we're going to, just highlight that there are some differences, right? So a loan from a CDFI might offer you more flexibility than a traditional bank lender. And the disbursement of funds is managed by BCL as a lender, the same way they would be managed by a traditional bank. Some of the similarities, there are interest and fees similar between a CDFI lender and a bank lender. You have to qualify for the loan. So expect that there's going to be a little rigor if you were to apply to a CDFI for financing, similar to what you might find if you applied for bank financing. There are loan to value requirements. And again, the disbursement of funds is going to be regulated by the lender. So in some ways, borrowing from a CDFI is similar to borrowing from a traditional bank, although there are more flexibilities and we are mission oriented. I think that's probably the real takeaway for the comparison between the two. Now, other sources of funds, right? So a lot of start up first-time developers hear about, non-traditional funding sources. Hard money is typically how we refer to it, and what you'll typically find in terms of those features would be that the interest rate is higher, the fees may be higher. The loan to value ratios may be lower and are likely lower than what you would find at a CDFI or a traditional bank. The terms are generally shorter than what you would find from a CDFI or bank. And the criteria for approval may be more lenient than the CDFI or the bank. So keep that in mind that, generally hard money is going to cost you a little more. And in reflecting back on some of the information that Sean shared, you may not get the technical assistance and the other support that you would get from a CDFI if you were to use a hard money lender. There are also government loan programs. And so, oftentimes many of these programs are accessible through mortgage lenders. And you can get them, kind of a FHA 203K loan, if you've heard of those, where you get a purchase mortgage and a renovation loan. And you do have to qualify for the loan, so keep that in mind. It does have costs and fees, and there may be a longer closing period and requires that an FHA approved construction specialist be involved in the process. So just to overview, there are various ways that as a developer you could get into the business of real estate development. Having some of your own resources is great to get you started. Your savings, if you're using home equity, you need to be very thoughtful and prudent about, how you'd want to use your resources. borrowing from a CDFI, borrowing from a traditional bank, just consider that you need to have your personal credit in order. All of that's going to be evaluated as a part of the underwriting, and that there is going to be some rigor to that process if you're borrowing from a CDFI or a bank. And then, of course, these other sources, hard money and government loan programs, typically FHA 203K. So we've covered a high-level general overview of the types of funds that developers typically use when they want to finance their projects. And now we are going to talk about things you need to know when you're trying to leverage your financing. And I'm going to toss it over to Deirdre Presley. Deirdre?
Thanks, Tracy. Good evening, everyone. So I'm going to pick up, my name is Deirdre Presley, and I'm going to pick up where Tracy left off, talking about the 5 C's of credit, the things you need to know as a new developer or intermediate developer going to look for financing from lending institutions, whether it be a CDFI or a traditional bank or hard money lender, whatever it might be, things that you need to know as you're moving your project forward. The first thing I wanted to kind of go into were the 5 C's of credit. The 5 C's of credit are what banks and other lenders use to evaluate a potential borrower and while making it in their process of making lending decisions. The 5 C's are character, capacity, collateral, capital, and conditions. So what we're going to do is briefly review those here to give you some idea of what they are looking for. The first thing of character is one of the most comprehensive ones, and what they're looking for in this part of the evaluation is credit worthiness, who you are, what your credit says about you. It basically says who your character is as a borrower. Will you be the person who would pay back the funds if they were to lend it, what your track record is, and how you make your repayments of funding or financing. So that's your character in this case. The next thing they look at basically your capacity, and what that is what your capacity is to repay the loan if necessary. There are a number of opportunities in the development process which can go a number of ways. Is if your project goes a little bit longer than anticipated, or something arises in the process where there are other funds that are necessary and time goes beyond what you're expecting. They want to know that you have the capacity to repay the financing that's in place, that they've lent you to do your project. And the next thing is capital. This represents your overall pool of assets in the name of the borrower. And a lot of it is really focused on the property in the sense of lending for real estate, the property that you're looking to purchase, renovate, if you were looking to sell that property, or if you're looking to hold it in a rental portfolio. So that would be acting as your collateral or capital in this instance. What it looks like. So your capital looks, shows who you are, what you have available to make those payments. It shows what your capacity is to do, make the repayments, for the loan that you're looking to obtain. Additionally, they provide conditions of the loan. Could be a number of things, but looking at, say, what your credit is, if there are any issues with the property. So conditions can come in a number of forms, making sure that you have the capacity financially and the capacity as far as development wise to handle and to oversee those conditions, to make sure that you correct those conditions prior to moving forward or during the process of the project. Any requirements that they might put on you for the financing. And the 6th C in this instance, we always say there's 5 C's are standard, but we just mentioned, but the 6th C is what we look at a lot of as a community lender. What impact your project will have on the community and how the community feels about your project or how the development project you're proposing. So what we're looking for you as a developer is being able to have conversation with the community. There are a number of community organizations in Baltimore City. I think there's somewhere around 200 and 20 or so. So any neighborhood that you'll be working in would definitely have a community organization, a community CDC of some manner in which you would be able to reach out to and have conversation with regarding your project, because you want to make sure that community is on board with what it is that you want to do with your development. We don't want a developer or investor to go into a neighborhood and to start spending money on a property and looking forward to doing a project and get ready to move forward with their plan, and then the community puts a stop to it. It could be a part of a zoning issue. Say if you were looking to renovate a property and put 3 apartments in that unit, but then the community has other plans for their neighborhood. They're looking for more housing for families and more single family housing, home ownership. So we definitely look for borrowers to maintain at least an initial relationship or reach out to community to make sure they have their input, because as many times that a community could make or break your proposed project. So definitely take that into consideration when you look at the 5 C's, when you're thinking about your character, your capacity, the collateral, the conditions, and the capital that's necessary to move a project. Please think about your community aspect of it, making sure you have that contact with the community, and making sure your project aligns with what the community sees for itself. And next, what we would like you to know is information that most lenders are looking for when you're going to look for leveraging for your project, when you're looking for to put an application forward to request financing. So the information that typically that you'll find, you're looking at a summary of your development experience. You want to make sure this is the time that you can take to show or to give a narrative definition of who you are. Make sure you're clear and concise about what your experience is, and what you've done in the arena of doing this type of development project. If you have experience, but clearly define what that experience is. And if you don't have much experience or you're new to development, please provide information that you're using some kind of development consultant, or you have a very experienced contractor that you're working with and they have a wealth of knowledge about renovating properties in the city of Baltimore. You want to make sure you're clear about that. And this is your one opportunity to be able to provide that to a particular lender so they know about who you are and what your intent is for the project. You want to make sure you give a great property description. You want to know what that property is, what you intend to do with the property. Be clear about that. You know, if you're looking to renovate the property to hold in your rental portfolio, be clear about that. If you're looking to renovate to sell the property, must really be clear, and just kind of define what the project really looks like. Is it one single family unit being sold, or is it one house when they're going to put 2 or 3 units in that property and you plan to lease them? You want to kind of know, have a foresight and do due diligence about what it is the lease amounts or rental payments would be for that property, because all those things you need to kind of put forward as early as possible. And when you're putting an application for financing into a lender, they want to know these things. They want to make sure that you're clear about what it is that you're doing and what the end result is. You're going to provide a scope of work and a budget. You want to make sure you're clear about the cost of your project. You want to make sure you're not going into a project unknowing, and you want to make sure that the market can bear the cost that you're proposing for your project. You want to make sure that you're not underestimating, or you're not making sure you're not over going with what the project is. So additionally, you're going to look at the impact on the neighborhood. That's one of the things what we talked about, looking at the community. So you want to make sure you've had those conversations and seeing how your project is going to impact the neighborhood. Timelines and things of that nature. You want to make sure that, you're clear about those budgets and what your timelines are, what the contractor believes is an adequate time to do so, and that you want to make sure that you include enough time to provide for incidents that occur that you don't know what actually could be in the future, something that arises that you had no idea about what was going on. You want to be clear about that. You want to make sure you have all of the information, like I talked about, what you're going to do with your rentals, any comparables. That would be great to provide. As much information you can provide going forward in the beginning is the best thing, so you're not leaving any gaps in the application. So you want to make sure you're looking at all these things, showing who you are as a developer or a new developer, with your experience of your development team, making sure your property description is there, you know what your budget and your scope is, the impact on the community, the timeline, and your project details. You want to make sure you put that forward as along with making sure that you are clear about your community impact. And then next, we want to talk a little bit more about some of the additional items that a lender might look for or will look for in your quest to leveraging financing. You want to make sure that you have your personal financial statements up to date and making sure that you understand what your personal net worth is going into the deal, which you look like financially. So you want to make sure you have that. You've gone through that process for yourself and understanding what you're presenting to a lender. Lenders will need to access your credit and understand what your capacity is, and that's what they're looking for in your financial information. So as a part of that financial information, you'll be providing a lender, say, 3 years of tax returns, 3 of your most recent bank statements, if there's savings and checking, if you have any investment statements, quarterly investment statements, stocks, you want to provide that so the bank or the financer should get a clear picture of who you are and what your capacity is financially to guarantee the loan that you're requesting, the funds that you're requesting for your project. And just make sure you're clear about that when you're moving forward. You're providing all those details to the lender so they know exactly where you are, who you are, and put your best foot forward. This is your opportunity to be sure that you're giving them everything that they need. So don't kind of skimp on saying, hey, I'll just give you one bank statement for this account. You want to put your best foot forward, paint a picture of who you are in totality. So you're looking to cover all the bases. So your lender understands clearly who you are. You want to put an application forward that the lender doesn't have to question a lot. So you want to make sure that you're covering all your bases and, dotting all those I's and crossing all those T's as you go forward through the application process with any lender. And also think about those credit worthy ideas, those 5 C's of credit, making sure you have all those things in place and do these things beforehand and don't wait until you're in application. And you don't want to provide piecemeal information. If you can put a full package together to provide to your lender, that's the best thing to do. And so lastly, what we have here is information, and we're going to toss this next section over to Roy Miller, who is our loan administrative coordinator at BCL. He's the person who you would first in line speak with when you're requesting funds from BCL if you're looking to leverage financing from our organization. So Roy.
Good evening, everyone. And once again, thank you for participating in this evening's event. As Deirdre mentioned, my name is Roy Miller, and I'm the Loan Administrative Coordinator. And I will be your first point of contact when you are initially looking to seek funding through BCL. I will assist you with the application and document upload, and of course, answer any questions you have with regard to our criteria and lending process. You can either access our application on our website at www.bclending.org, or you can just contact me directly at my direct line at 410-862-0938, or by email at roy.miller@bclending.org. And I'll be more than happy to supply you with all the necessary initial documentation you'll need to get started. And then once you have completed an application and submitted documentation, I'll see you through the process of the application right up to pre-underwriting and close it.
So I think, Teresa, we're back over to you to open up for questions.
Great, thank you. That was a really good presentation, and the chat has been going very well. There are tons of great questions. I think some of them have been answered, but I am going to ask them so that you can answer for those folks that are calling in. Starting with the first question, which is, what is mission oriented? What does that mean?
I think this is Sean. I'll pull that one. As far as mission oriented, it means that, and Deirdre talked about this a little bit as it related to the 6C. We work in, the low and moderate income and basically resource deprived neighborhoods within the city of Baltimore. And we are looking to make sure that your project is consistent with what the neighborhood is looking for, the neighborhood that you're working in. And also, we're focused on making sure that your project is transformative and is stabilizing an area and is basically helping make the neighborhood better, and basically also helping put properties that are in disrepair back into full use as they were originally intended. And so basically through the rehabilitation loan process, basically we're hoping that we're leaving with our loan and your real estate project, the neighborhood in a better place at the end of the day. So that's what we mean by that.
Great, thank you, Sean. Another question is, can the amount borrowed go toward multiple single families to meet the $225,000 minimum?
Deirdre, do you want to handle that?
Sure. I believe I heard you correctly. You said, can multiple units go towards?
The question is, can the amount that's borrowed go toward multiple single families to meet the $225,000 minimum loan requirement?
Yes, the answer is yes, it can. Say if your one project really only requires $150,000, which is a smaller loan than we would like to do, the second project would make the difference. So both projects together can be put together to meet the minimum.
Great. Okay. All right. Another question we have is, what if we already own the properties and we need help with rehab costs? This looks the same as regular banking criteria.
So if you already own the properties, what you would want to do is have an evaluation done by an MHIC contractor to determine how much it would cost to renovate them. And when you get that information together, then you could certainly reach out to Roy and start the pre-application process to get all of your documentation submitted, and we would begin to understand what type of product might be the best fit for the type of project you're doing, whether it's you're renovating to rent, to hold and rent, or to sell.
And if you already own the property, basically that is, that could become your equity in the deal, and basically would make it possible for us to look at financing some of the soft costs and some of the other costs relating to the loan.
Great, thank you both. This actually kind of ties into that question is, what's the term of the loan?
The loan terms can vary, and it really is based on the deal that you're presenting or you're looking to finance. Like there's a different loan term for 1 unit versus someone who's coming in to do 14 units. So the term really does typically fit the loan and the experience of the developer that's bringing that loan to the organization. So it could range. Typical loan terms, could range somewhere from 9 months to 18 months, So it really is based on the deal.
Okay. Thank you, Deirdre. Let's see. Is there any other program or flexibility for a smaller loan amount?
Smaller loan amounts, really, like you said, the flexibility really comes if there is more than one project. And if a developer doesn't have the experience to do more than one, it's sometimes a little difficult to meet that smaller number, because really when you look at the cost that it takes to close a real estate transaction, you don't want to go into a loan that's extremely small and incur all those costs. It really might tip the balance of the feasibility of your project. So that's why we say around $250,000, where it starts to make a lot of sense for a developer to leverage financing in this capacity.
Yeah, and the other thing that I would add to that is basically for the smaller one-off, or individual property type projects that get done and get financing, those are typically being financed by what Tracy was talking about, like using personal resources, IRAs and, funds you have on account, HELOCs, home equity loans, or another source that is kind of embedded in that, which is basically friends and family, because it's just these costs that are involved with putting a loan in place really would make those difficult to do.
Okay, great, thank you. Let's see. Could churches apply for loan opportunities, and can loans be supplemented with Maryland capital bond programs?
Yes and yes.
Yeah.
What are the refinancing options post-construction?
Deirdre, you want to take that?
Sure. Refinancing options really are specific to the borrower. We see a number of our borrowers go to regional lenders in the area who are happy to take out a performing loan. So it really is based on what kind of project it is. So we are what we consider a short-term lender. So we can lend our funds up to 5 years on those properties that are being maintained in a rental portfolio. So you have to take it upon yourself to really look for a lending institution that fits your needs and that your project could be refinanced by. So it's not something that we kind of send you to someone. It's really the borrower doing that due diligence to make sure that they're finding a lender to take out their project.
Got it.
The other thing I would add there is that basically doing refinance post construction doesn't meet our kind of mission focused and community stabilization focus of kind of our mission as a nonprofit, because we're looking to have your loan be that, make it possible for that rehabilitation and stabilization to occur. So we don't typically look at providing just mini permanent or permanent financing for completed projects.
Thank you. There are a lot of questions coming in pretty quickly. This is a group one, I like this one. Do you work with the vacancy value program? Can you explain that a little bit? One of the things that I think would be helpful is many of the properties in our inventory are in neighborhoods where there's a very high number of privately owned vacants. Getting appraisals, getting insurance, getting financing are challenges oftentimes. Can you talk about how Baltimore Community Lending understands that scenario?
Go ahead. Go ahead, Deirdre.
Okay, we definitely understand that. I guess that's a part of being a mission-based lender. We are located in the city of Baltimore. We know the neighborhoods. We've been lending in Baltimore City for over 30 years. So we have I guess I say a finger on the pulse in the neighborhoods in Baltimore City. And also we do have great relationship with the city and many of its agencies, and especially Teresa's arm, because we've done a number of deals with developers who've purchased properties from vacants to value, and we work with them through the process. If they've already gone in to kind of look at properties and found properties that they want, and they're starting the process, and they come to BCL, and we talk to them about their project and make sure it fits our mission and our project detail, and we can work through that process with you and offer, if we believe it's something that we can do and it really is feasible, a letter of interest to the potential borrower for submission with their application to vacancy to value. So we definitely can work hand in hand, and we can finance vacancy to value project, and that's definitely many other projects or properties that many of our investors work on in those underserved communities. So, and a number of other programs also, we definitely can go hand in hand.
Yeah. Yeah, thank you. And what I would add to that is basically, if you're looking at doing a project, we want to make sure you're going to be successful. So if you're looking at doing a project in a neighborhood or on a block that is 60 to 80% vacant and blighted, whether the properties are owned by the city or owned by private investors, that's probably not a project that we're going to be able to help you with unless you're doing enough of the project to flip that equation to where it's going to be 60 to 80% stabilized. Because again, we really want you to be successful, and we also want to make sure that the neighborhoods are getting to the point of better stabilization through the projects that we're financing and the projects that our borrowers are doing.
Great, thank you both. And thank you, Roy and Tracy, for helping in the chat with the questions. Another question that we have, actually two that came in the same, was what FICO score is needed, and what about LLCs? How does the FICO scoring work?
Tracy, you want to take that?
Oh, I was responding to the chat, so can I punt that back to you?
Could you run that one by
Deirdre?
Tracy? Yeah, Teresa, could you say it one more time?
Sure. It is what FICO score is needed, and if as it pertains to LLCs, how does the FICO scoring work?
Okay. As far as BCL is concerned, we don't have a stated minimum FICO score. We do look at each individual based on their capacity or their character as far as their credit. And if it's an LLC, we look at the primary or the principals of the LLC, and we underwrite their financials individually as a collective LLC, as the members of the LLC. So in many cases, they don't have a number of, say 3 years of tax returns or audited financial statements, things of that nature. What we do is fall back to the individuals of the principals of that organization.
Thank you. This is a scenario. One of our attendees has purchased a block with 5 abandoned homes, and they all have tax liens. Would lending or financing through your organization help them with the tax lien as well as the rehab?
I will take that. As far as the tax liens, if you own the tax liens, I mean, the real question here is, when do you own the property? We can't finance something where you don't own the property, and we can't finance something where we can't get a clean first deed of trust lien on the property.
That answers that question. What are the primary areas that you work in? East Baltimore, West Baltimore? Are there specific communities?
We work in the city. Oh, okay, I'm sorry. Go ahead, Sean.
We work basically in all neighborhoods within the city. Where you will not find us working are basically in the communities that are kind of around the water, Federal Hill, Canton, areas that don't need our help. Essentially, the areas where you won't find us. You're not going to find us in Guilford, unless it's a project that is a much larger project that is probably involving tax credits and has a very defined affordability overlay and requirement for the property long term. We work in what are low and moderate income census tracts. So we are in east and west, north and south, but we're in the neighborhoods that basically need a little help to become more stabilized and to preserve and improve the housing that is there today, or the commercial areas that are there today, because we also do commercial loans and mixed use loans.
Okay, thank you. All right, we are continuing to come. So, let's see. So should the interested lender or person looking for the loan pre-qualify with you first before finding a property?
I'll take that one, Sean. It would be great if you reach out to us and kind of talked about what your plans were. Sometimes like Sean mentioned previously, if there's a property that you're interested in purchasing and it's on a block that's mostly vacant, that would probably be a project that we wouldn't want to participate in or to provide financing for. So coming to us and talking about the project prior to is a good thing. So that would be a plus for, especially for a newer developer, making sure that they're in the right area.
Great. Right. When considering developer experience, do you account for experience in other cities within the DMV?
Sure, we definitely would consider that as experience, especially if it's evidence as it's dealing with like full renovations, if that's what they're looking to do here in Baltimore City. We definitely would look also to see if who they were using as a contractor. This is where the contractor could play a larger role in finding out if that contractor has experience in doing renovations in the city of Baltimore, because it is a different beast than doing a project in Baltimore County or PG County or in DC. So we look to see if that contractor has that experience working in Baltimore City, but we look to see and utilize experience of developer in other areas, definitely.
Is this strictly related to individuals or can a nonprofit apply? This person works with the St. Vincent de Paul and looking to develop 100 units for homeless families in Baltimore.
Oh, most definitely. It's not only individuals. We do LLCs and other structured organizations. So it doesn't have to be an individual.
What are the typical interest rates and origination fees for your loan?
What I can tell you is that our current interest rate is 6%. And it can fluctuate, and it really is based on what we use is prime plus a 2%. But we do have what we call a floor, which is the lowest that we can take our interest rate based on our cost of funds as an organization. So currently our interest rate for commercial construction financing is 6%. And the fee ranges from 1% to 2%, and that's assessed based on the risk of the deal. So the riskier the deal, the higher the fee is, probably at the 2% level, and the less risky, the lower it would be.
Thank you, Deidre. Next question is, are your rates typically, you may have answered this in this question, are your rates typically lower, LTVs higher? Or what is the main reason someone should work with BCL instead of a regional bank?
I think the answer to that one is yes and yes, and in comparison to basically the hard money lender example that was discussed by Tracy, because they do lower loan to values, higher fees, higher interest rates typically, and whereas they might go to 60%, 65%, we typically will look at doing 70 to 75% of the as-is value at the loan closing and up to 80% of the as completed and stabilized value on the all-in for the loan for a particular project.
Let's see, when do payments on the loan begin?
That's based on when the money gets drawn down. So effectively, when you start to draw out the money, the interest starts to accrue, and basically interest would need to be paid kind of on a monthly basis based on what's outstanding from the prior month and any new draws that are taken down. What I would say is basically we structure our loans, we always structure our loans basically to provide two things. We want there to be a hard cost contingency for the project based on your contractor's contract and basically the risk that's assessed in the project by our construction specialist, Ned Fields. And then basically the other thing we look at doing is we look at basically assuming it's going to take you whatever period of time, 6 months, 9 months to do your project, we will make an analysis of that and determine what we feel the interest carry is going to be for the loan over that term. And essentially we will make that an interest reserve that is built into the loan, because we want the loan to be basically self-sustaining from the time that you close it to the time that you either sell it and repay it, or basically have the loan stabilized with producing enough income to provide for the debt service on the loan. And the reasoning behind that is basically equity needs to be determined and really dealt with kind of at the initial closing of the loan, and then basically the BCL loan kind of carries it to the point where it creates the money for paying the loan or repaying the loan.
This looks like it may be the last question from the chat. It has been answered, but I do want it to be on this recording because it's a popular question. Do you have a list of established contractors or participants that you've had success with, and or where can a new developer find established contractors in the city?
Deirdre, you want to field that one? I wish we had ability to unmute Ned so he could address that.
We can, if you need to, I can do that.
Okay, I'll start to say that we do not have an established list of contractors for for potential developers to look to. We don't make referrals in that manner. What we do is try to vet any contractor that a new developer or a proposed borrower would bring into their project. That's where Mr. Fields, our construction manager, comes into play. He looks at all of the deals. We have a contractor to fill out a qualification form, listing references and experience and understanding their licensing that's in place. And Mr. Fields typically reviews that for us along with the scope and budget from a contractor. If we have concerns about the contractor's capacity, we'll reach out to them and have some conversation to make sure they are the right contractor to complete the proposed project. In that way, we provide that information to the borrower and they have the opportunity to move forward with that contractor or to look to see someone else that could be better suited for their deal.
Thanks, Deirdre. I think we've got Ned unmuted. So Ned, if you wouldn't mind taking a minute.
Yeah, sorry about that, everyone. I just stepped for 1 second and I missed what was the question.
The question was, do we maintain a list of qualified contractors, and what are some of the things that go into the qualifications for the contractors that we will approve for the loans?
Sure, that's a good question. Everyone, no, we do not maintain, because as a lender, we don't want the liability of one, keeping a list that we have to monitor, and two, we don't want ones to think that we are promoting certain contractors. We want you to do your due diligence and screening people you feel comfortable with. And two, what our criteria is when it comes to the rehabilitation of these projects, we prefer that it be a Maryland Home Improvement License contractor. The reason for that is there's recourse when it comes to the type of contract they have to have, when it comes to the criteria they must meet with the state. So that all helps you out if things do not go well with you on a legal side, but also on with us as the lender. We will be also partnering up. We sign an agreement with the contractor to make sure that the work is completed, and that in itself, we prefer being in agreement with people that are monitored by the state.
Great, thank you so much, Mr. Fields. Another question we have is, can different people / developers join together to meet the loan minimum?
Yes. The basic answer there is Teresa, is yes. I mean, they would basically need to be doing it kind of as, they would all be borrowers and guarantors if they formed an LLC, basically to do multiple properties. Yes, they could work together, and hopefully they would, as a group, would be stronger and have more experience and be able to pass kind of the underwriting that Deirdre went through in kind of approaching the project. Now, having said that, I will say that, choose your partners well. You want to make sure, depending on what type of project this is, that it is clearly someone that you're prepared to be with and work with for the duration of the project and the loan until it's repaid. So whether you're doing home ownership or you're doing investment properties, you want to make sure that you know who your partners are and are confident that basically you're making the right marriage into the relationship to do this.
All right, I think we have ended most of the questions that are coming in. Last one says, you're financing rental loans or only short-term loans?
Well, by saying we are a short-term lender, we're not like, you can't go to us for a 20 or a 30-year mortgage. We will do investor loans that cover both the construction term to basically complete and stabilize the number of units or units that you're doing as it relates to a property that you're holding in your rental portfolio. That loan basically automatically converts when the properties are finished and stabilized. And that we normally measure that by getting a use and occupancy to, basically at that point you should be renting them up and they should be producing income. And essentially the loan at that point will go from being a floating loan to a fixed rate loan. Today, again, that cost is 6%, as we discussed earlier. We would have it amortized. Normally our amortization schedule is a 20-year schedule. However, that would have a loan, the loan's actual term would only be another 5 years. Basically, if it was a 12-month construction loan, basically you would have 72 total months. And at that point, the loan would have a balloon maturity and repayment requirement that basically is the unamortized portion of the loan that remains at the end of that 72 months, plus whatever interest and fees and everything else that are associated with the loan at that point in time.
All right, I'm going to make this our last question because we are actually at the 6:27 mark. What is the criteria for areas in which BCL would lend money?
I'm going to let Tracy jump in on that.
So we will lend money in Baltimore City, and our focus is to provide financing in neighborhoods that are going to, that have historically been disinvested and where there's a need for redevelopment. So we are looking for neighborhoods in low and moderate income census tracts in and around Baltimore City.
Thank you so much, Tracy. Thank you all so much. And thank the team that we had a whopping 106 people on this workshop, which was awesome. I am putting in the chat your general email, but if the presenters would just like to add their email addresses to the chat, that would be really helpful. I thank everyone for participating. I do want to give a reminder that this recording will be posted on our YouTube page, which the link is included in the chat. And again, just thank everyone for coming out. Sean, Tracy, Deirdre, Roy, Ned, you guys did an awesome job. And we appreciate what you're doing to help revitalize our great city.
Well, thank you very much. And we appreciate the opportunity and thank everyone for attending. And we hope to be able to work with all of you in the future.
Great. Thank you all for joining us. Everyone have a good night.
Thank you. Good night.
Thank you. Good night, everyone.
Good night. Thank you.
Good night, everyone.
Thank you.